Did you know Australia now holds one of the highest household debt levels in the world, higher than the US, the UK, and almost every major economy? And with over 60% of mortgages already under financial stress, the cracks in our economic foundation are getting harder to ignore. Grocery prices are up, rent has skyrocketed, and more Australians are relying on credit just to get through the week. This isn't just bad luck. It's a perfect storm of rising interest rates, stagnant wages, global instability, and a housing market teetering on the edge. Economists are warning that the signs look eerily similar to what we saw just before the 2008 financial crash. But here's the difference. This time, it's happening in our own backyard, and most people don't even realize how close we are to the edge. In this video, we are breaking down the 10 warning signs that prove Australia is heading straight into its worst economic crisis in decades. Some of them are hiding in plain sight, and they could change everything for you and your family. Number 1. Rising household debt. Imagine this. You're working full-time, paying your mortgage, covering groceries, and trying to save a little, but somehow, your bank balance keeps shrinking. You're not alone. Australia's household debt-to-income ratio has soared above 180%, making it one of the highest in the developed world. That means for every dollar Australians earn, they owe nearly $2. It's a ticking time bomb that's quietly growing behind closed doors. With interest rates rising rapidly, that debt is becoming harder and harder to manage, especially for families who took on massive loans during the property boom. The scary part? A large portion of this debt is tied up in housing, where property prices have exploded far beyond wage growth. During the pandemic, many Australians were encouraged to borrow big while interest rates were at record lows. But now, those cheap mortgages are being hit with steep rate hikes. Monthly repayments have jumped by hundreds, sometimes thousands, of dollars, pushing everyday Aussies closer to the financial edge. Even a small rate increase can send ripple effects across households already living paycheck to paycheck. What makes this crisis different is how invisible it can feel until it's too late. Debt isn't something people talk about openly, but behind closed doors, more and more families are using credit cards to pay bills, dipping into savings, or skipping essentials just to stay afloat. The truth is, this level of household debt doesn't just affect individuals, it weakens the entire economy. When people cut back on spending to keep up with debt, businesses suffer, jobs are lost, and the economy starts to contract. Rising household debt isn't just a red flag, it's the first domino in a chain reaction that could collapse the system if left unchecked. Number 2. The housing bubble. For years, Australians have been told that property is the safest investment. Buy now or miss out forever, they said. But behind the headlines and real estate hype, there's a dangerous truth. Australia's housing market is one of the most overvalued in the world. According to recent reports from the IMF and CoreLogic, house prices in cities like Sydney and Melbourne have soared far beyond what average incomes can support. This isn't normal growth, it's a classic bubble, inflated by speculation, cheap debt, and unrealistic expectations. What makes this even riskier is how heavily leveraged people have become to buy into the market. First-home buyers are stretching their budgets to the absolute limit, banking on prices continuing to rise. Investors are piling into multiple properties, hoping for quick capital gains. But what happens if prices fall just 10%? For many, that would wipe out their equity, leaving them with loans worth more than the homes themselves. And we are already seeing early signs, properties sitting longer on the market, discounted listings increasing, and auction clearance rates starting to fall. A bursting housing bubble doesn't just hit homeowners, it hits everyone. Construction slows down, consumer confidence drops, banks tighten lending, and when that happens, the entire economy feels the shockwaves. Think it can't happen here? It already has. Look back to Perth after the mining boom, or even further to the housing crash that helped trigger the global financial crisis overseas. The difference now? It's bigger, more widespread, and thanks to rising interest rates, it's more fragile than ever. If the housing bubble bursts, it could be the trigger that turns a slowdown into a full-blown economic disaster. The question isn't if it will pop, it's when, and whether you'll be ready. Number 3. Stagnant wage growth. Here's a harsh truth. While the cost of everything keeps going up, your paycheck isn't. In fact, over the past decade, real wages in Australia have barely moved, even as inflation eats away at buying power. According to the Australian Bureau of Statistics, average wages have failed to keep pace with the cost of living for years. That means even if your income has technically gone up on paper, you're still able to buy less than you could 5 years ago. It's like running on a treadmill that keeps speeding up, No matter how hard you try, you're not getting ahead. This isn't just frustrating, it's dangerous. When wages stay flat while everything else gets more expensive, people turn to debt just to maintain the same standard of living. And once they're maxed out, they start cutting back. That means less spending at local businesses, less money going into savings, and more financial stress on families. It also creates a wider gap between income brackets, with middle and lower income Australians feeling the pressure the most. Over time, that leads to economic inequality, social unrest, and long-term stagnation. You might be thinking, why aren't wages going up? There's no simple answer, but experts point to a mix of factors: increased automation, weak bargaining power for workers, and a shift toward casual and contract employment. More Australians are working multiple jobs just to survive, yet their total income still isn't enough to keep up. When workers aren't earning more, they can't spend more, and that drags the whole economy down. It's a silent crisis that doesn't make headlines, but it's already reshaping the financial future of an entire generation. If wages don't rise soon, the weight of inflation and debt could pull the entire system under. Number 4. Record level inflation. Go to the supermarket today, and you'll probably notice it. Everything costs more, a lot more. Bread, milk, meat, petrol, rent. Prices have shot up across the board. This isn't just your imagination, it's inflation, and right now, Australia is facing its highest inflation levels in over 30 years. The Consumer Price Index has jumped dramatically, with essentials like food and housing seeing double-digit increases. And for the average Aussie, this means your dollar simply doesn't stretch as far as it used to. What's more alarming is that wages haven't kept up, so even if you're earning the same or slightly more, you're actually falling behind. This is called real income loss, and it's quietly crushing household budgets. Families are cutting back on non-essentials, skipping meals, delaying healthcare, and dipping into savings just to survive. And it's not just low-income earners feeling the heat. Middle-class families are now making hard choices between bills, rent, and groceries. The pinch is everywhere, and it's only getting tighter. Inflation this high creates a ripple effect throughout the economy. Businesses are forced to raise prices or shut down. People spend less, which slows growth. And central banks respond by hiking interest rates, which can make mortgages, loans, and credit card debt even more painful. It's a vicious cycle. If inflation continues at this pace without wages catching up, we could see widespread financial instability, the kind that shakes consumer confidence, stalls investment, and pushes entire industries to the brink. The scary part? It's already happening. And for many Australians, this isn't just economic theory, it's their new everyday reality. If even one of these warning signs felt familiar, you're not imagining it. The storm is building, and now is the time to prepare. We'd love to hear your thoughts. What changes are you seeing around you? Also, don't miss our previous video that breaks down how to protect your money during a financial downturn. It could make all the difference. We pour our hearts into every video, so if you found this helpful, please support us with a quick subscribe. Just one click means the world to us. Number 5. Unstable job market. On the surface, Australia's unemployment rate looks stable, but dig a little deeper, and the picture gets worrying. More Australians than ever are stuck in insecure work, casual contracts, gig economy jobs, or part-time roles without benefits. According to recent ABS reports, underemployment is rising, and job security is slipping. Even full-time workers are feeling uncertain, with many industries quietly cutting hours, freezing hiring, or automating roles altogether. The traditional 9-to-5 job is disappearing, and with it, the stability that once kept the economy strong. This shift toward insecure work creates serious long-term problems. People working multiple part-time jobs often don't have sick leave, superannuation contributions, or consistent income. That means they're less likely to spend, invest, or borrow with confidence, key drivers of economic growth. When workers don't feel secure in their future, they pull back. And when millions do that at once, it slows the entire economy down. We are not just talking about a few Uber drivers or freelancers. This trend is affecting teachers, nurses, tradies, and more. The worst part? Job insecurity makes households extremely vulnerable to sudden shocks. One missed paycheck can mean falling behind on rent, defaulting on a loan, or having to rely on credit just to buy groceries. During tough times, casual workers are often the first to be let go, leaving them with no safety net. If a downturn hits, we could see a wave of job losses, especially in sectors already running lean. And with little government support or affordable housing options available, this could spark a deeper social and economic crisis. The truth is, without stable employment, there's no stable economy. And right now, that foundation is starting to crack. Number 6. Global economic pressures. Australia might feel like it's on the edge of the world, but when it comes to the economy, we are deeply connected to global forces. What happens overseas doesn't stay overseas. It hits us hard and fast. Right now, the world is facing a storm of economic instability. China's economy is slowing down, the US is battling inflation and rising debt, and global conflicts are disrupting trade routes and supply chains. Australia, heavily reliant on exports like iron ore, coal, and agriculture, is highly exposed to these shifts. Take China, for example, our largest trading partner. As its economy cools, demand for Australian resources drops, which hits our mining sector, jobs, and tax revenues. At the same time, global shipping costs remain volatile, pushing up prices for imported goods. Add in high US interest rates and instability in European markets, and you've got a recipe for serious pressure on the Australian dollar, investment confidence, and economic growth. These aren't distant problems. They directly impact our jobs, our businesses, and our everyday costs. What makes global pressure so dangerous is that we can't control it. Even if we manage things well locally, a global shock, like a market crash, a major conflict, or a recession in a key economy, can send shockwaves through Australia. And we are already seeing early signs: falling export values, reduced foreign investment, and unstable currency trends. If the global economy takes another major hit, Australia won't be spared, and we may be even more vulnerable now than we were during the GFC. The scary reality? We are sitting in a small boat while the waves are building all around us, and no one's sure how high the tide will rise. Number 7. Interest rate volatility. If you're a homeowner or have any kind of loan, you've probably felt it. Interest rates are rising fast, and they're not done yet. In just over a year, the Reserve Bank of Australia has raised the cash rate multiple times to try and control inflation. But while that might help cool prices, it's causing serious pain for everyday Australians. Monthly mortgage repayments have soared, in some cases by over $1,000 a month, putting enormous pressure on household budgets that were already stretched thin. This kind of interest rate volatility creates economic shockwaves. People with variable rate mortgages are now cutting back on everything, from groceries to school fees, just to keep their homes. Credit card debt is also climbing, with interest charges stacking up faster than people can pay them off. And small businesses? They're feeling it too. Loans are more expensive, margins are shrinking, and many are being forced to downsize, delay projects, or lay off staff just to survive. When borrowing becomes more expensive, the whole economy slows down. The uncertainty is what makes this so dangerous. No one knows how high rates will go, or how long they'll stay up. That makes it nearly impossible for families and businesses to plan ahead. Should you buy a house? Take out a loan? Expand your business? For many, the answer is simply not now. And when enough people freeze their financial decisions out of fear, growth grinds to a halt. Interest rate volatility doesn't just affect your bank account, it shakes the entire economy's confidence. If the pressure keeps building, it could lead to widespread defaults, forced sales, and a painful economic contraction that will hit hardest at the community level. Number 8. Consumer confidence is dropping. When people stop spending, economies start slowing, and that's exactly what's happening in Australia. Consumer confidence has dropped to some of its lowest levels since the early 1990s recession, according to data from Westpac and ANZ Roy Morgan surveys. Australians aren't just tightening their wallets, they're afraid of what's coming next. Rising costs, job insecurity, and housing stress have created a climate of uncertainty, and that fear is turning into hesitation. People are holding back on purchases, canceling travel plans, and avoiding new financial commitments altogether. This drop in confidence is more than just a mood. It's a key driver of economic decline. When consumers don't feel secure, they stop spending on non-essentials. That means fewer sales for businesses, more pressure on employers to cut costs, and ultimately, more job losses. It becomes a self-fulfilling cycle. Low confidence leads to less spending, which leads to weaker businesses and rising unemployment, which then drives confidence even lower. Even industries that usually stay strong, like retail, hospitality, and tourism, are now feeling the chill as consumer behavior shifts from how much can I buy to what can I live without. What's especially worrying is that this isn't a short-term dip. Confidence has been falling steadily over the past year, and every new rate hike or economic warning only adds fuel to the fire. Australians are not just reacting emotionally, they're responding to real financial stress. And when confidence drops across a whole population, it becomes incredibly difficult to reverse. Recovery takes longer, and every sector feels the slowdown. A fearful public doesn't spend, doesn't invest, and doesn't grow the economy. That's why collapsing consumer confidence is such a dangerous sign. It doesn't just reflect the problem, it accelerates it. And if nothing changes soon, that fear could help push Australia straight into a full-blown recession. Number 9. Business insolvencies are rising. Behind the glossy storefronts and online shops, a storm is brewing in Australia's business sector. Insolvencies, businesses collapsing under financial pressure, are rising at alarming rates. According to ASIC, Australian Securities and Investments Commission, business insolvencies have jumped more than 30% compared to the previous year, with small and medium-sized enterprises, SMEs, hit the hardest. These aren't just failing startups, they're long-standing family businesses, local shops, tradies, and service providers that simply can't keep up with rising costs, supply chain disruptions, and shrinking customer demand. Many of these businesses survived the pandemic thanks to temporary government support. But now, that support has ended, and they're facing a brutal combination of higher interest rates, soaring energy prices, staff shortages, and reduced consumer spending. When revenue drops but expenses keep rising, it's only a matter of time before the cash runs out. And for small businesses, who often operate on tight margins, just one slow month can be fatal. Once these businesses close their doors, the impact spreads. Employees lose jobs, suppliers lose contracts, and entire communities lose essential services. But the real danger lies in the domino effect. Business closures weaken local economies, and as more companies fold, confidence across the sector collapses. Investors pull back, lenders tighten credit, and startups delay launching altogether. This leads to less innovation, fewer job opportunities, and slower growth across the board. The small business sector employs nearly half of Australia's private workforce, so when it struggles, the entire economy suffers. It's not just about economics, it's about livelihoods, families, and community stability. If the trend of rising insolvencies continues, we are not just looking at a few unfortunate closures, we could be watching the slow erosion of the backbone of Australia's economy. And once that foundation starts to crumble, recovery becomes much harder and much longer. Number 10. Government debt and policy uncertainty. While much of the focus is on household and business struggles, there's a far bigger problem looming over Australia's economy: soaring government debt combined with growing policy instability. Since the pandemic, Australia's national debt has surged past $1 trillion, a number that was once unthinkable. To fund stimulus packages, job support, and emergency measures, the government borrowed heavily. But now, with interest rates climbing, the cost of servicing that debt is rising sharply. Billions in taxpayer dollars are now being used just to pay interest, not reduce the debt itself. The real problem isn't just the debt, it's the lack of a clear plan to manage it. Political parties are divided on spending priorities, tax reform, housing affordability, and climate action. Constant changes in direction and leadership shake both investor and public confidence. One budget promises relief, the next talks about cuts. Will there be increased taxes? Cuts to services? More borrowing? No one really knows, and that uncertainty makes businesses and individuals hesitant to plan, invest, or spend. When a government looks unsure of its direction, the entire economy feels it. High national debt also limits the government's ability to respond to future crises. If a recession hits, or another global shock occurs, there may be little financial firepower left to provide meaningful support. That means more people could fall through the cracks, losing jobs, homes, or businesses, with no safety net. And with trust in government falling and political tensions rising, there's growing concern that the policies being made today aren't setting Australia up for long-term stability, but short-term survival. When both households and the government are carrying unsustainable debt levels, without a united strategy to fix it, the risk of economic collapse becomes not just possible, but probable. This is the final warning sign, and perhaps the most dangerous of all. Australia is standing at a critical crossroads, and the warning signs aren't just coming from economists or the media. They're in our homes, our jobs, our businesses, and our wallets. From the crushing weight of household debt to the quiet collapse of small businesses, from the invisible pain of stagnant wages to the global tremors shaking our local economy, the evidence is all around us. But the scariest part? Most people won't notice until it's too late. They'll keep spending, borrowing, and hoping for the best, unaware that the very ground beneath them is shifting. This isn't fear-mongering, it's a wake-up call. Economic crises don't always hit like a sudden explosion. Sometimes, they creep in slowly, until they're unavoidable. The good news? Knowledge is power, and if you've watched this far, you're already ahead of the curve. You now know the 10 major signs pointing to a possible economic downturn in Australia. More importantly, you know what to look out for, and what conversations we all need to start having, with ourselves, our families, and our communities. So don't just scroll past this. Reflect, prepare, share, and be part of the growing number of Australians who refuse to be caught off guard. Because if a crisis is coming, and all signs say it is, it's those who saw it early who'll be ready when it hits.